Michael Hartzman. Tonight's broadcast is Tuesday, December 26th, 2023. In full disclosure, we are recording this at 1 p.m. on Friday, December 22nd to do a market wrap-up. How are you, Dominic? Good evening.
Doing very well, Mike, on this year-end final. I think it's our final podcast for the year. So grateful to be here with you, Mike, and doing very well. How
Yeah,
about yourself?
we are officially out of runway for 2023. So it's our final podcast of the year. And as I said, we're recording it on Friday, December 22nd. The market's kind of flat today. And we're going to do a market wrap up for the year and maybe peek ahead into 2024. But before I do that, let's just go over the numbers, Dom, and then we can kind of get into the nitty gritty. It's been a wild year for the market. I think most people, think the market was kind of flat or down, and we went up in the beginning and then we went down and then it was just kind of bumping around. But when all's said and done, Dom, the S&P is actually up about 25%. The NASDAQ is up an insane almost 43%, and the Dow is up only 15% for the year. It's been, last year the market was rough to say the least, but this year it's been quite an impressive ride. And I would say impressive and a little stealthy at the same time.
Yeah, I'm actually really happy you brought up that last part of the comment, Mike, because on the surface the numbers are just downright gaudy. And quite frankly, a lot of people don't believe in those numbers. They think somehow they're fudged, and they're not, right? Those numbers are ballpark pretty accurate. But we've talked about this in our past podcasts. When you start digging and deeper into those numbers, when you start looking under the hood, it really is a tale of two cities. So the good news is it's actually good news. But the reality check might be that, hey, the markets have a lot more work to do, and that I think positive for 2024, but maybe not quite as exciting year end as the numbers imply.
Yeah, I would agree with that, because if you look back to where we were July 1st, the first half of the year, I think, Dom, at the end of the first year, the market was up 20%. And everyone was super nervous about that 20% from the point of view, and we've talked a lot about this with our guests amongst ourselves. The first half of the year was basically driven to what the media started to refer to the Magnificent Seven. Seven tech stocks that were heavily driven by, the market finally waking up one morning and realizing artificial intelligence is here to stay, and they were called the AI trade. But I would venture to say the first half gain really was a market filled with skeptics. No one really believed, I don't think, that first half move was legitimate, for lack of a better word. And it feels like this move since November 1st basically has a little bit more reality to it and a little bit more sticking power to it.
Yeah, so maybe let's spend a moment, because I think you are spot on, Mike. Let's spend a moment and go, where were we in January 1st of this year, right? And clearly the whole discussion was inflation is out of control, and what is the Fed going to need to do to bring it back into a reasonable number, their 2+% target. How much are they going to raise interest rates? And Mike, you and I from day one said we don't see this in the horizon. We don't believe in it. But many of the experts, we will definitively be in a recession this year. And a recession means companies are not going to make money. Their profits are going to go down dramatically. And therefore, the market was going to behave accordingly, right? And that simply didn't happen, Mike.
Soft landing, hard landing, no landing. That was the debate. You're right. For probably the first 6, 7 months of the year. And you and I would spend a lot of time telling our advisors and telling our clients, you want interest rates to go down, be careful what you wish for, because it meant that the economy basically fell off a cliff. And I'm happy that it didn't fall off a cliff.
Yeah, I think we're not here to call anybody out, Mike, but the experts out there that were talking about a dramatic decline in growth, economic growth, a dramatic decline in earnings in the S&P. And we talked about it all year long, where the S&P was supposed to earn about $235, and there were quote unquote experts out there talking that number would drop to $180, $185 again, which means a significant drop in value of stocks and obviously the S&P. And although earnings for the year did decline overall, they were nowhere near as dramatic as some people expected. And the economy has held up. The economy did not go into a recession. The employment numbers have held up pretty solid throughout this whole process. And you can argue what comes first, the chicken or the egg. Did the economy not roll over because of the employment numbers or vice versa? But overall, the economy has held up pretty well. Corporate profits have held up pretty well.
You're right. But I think, Dom, we would be remiss if we didn't spend at least a few minutes talking about what happened in the first quarter of the year, which now seems like it was years ago. But do you remember? Are you old enough to remember the banking crisis of 2023?
It just seems like a blip, right, Mike? And,
Yep.
and what's strange is look, I'm kind of torn here because the reality is that we're going to be able to look back now at 2023, and in some ways, Mike, it just looks so easy, right? It's just like, oh yeah, it all worked out. What was complicated about it? But let's talk about the banking crisis. We had three banks taken over by the government, right? And the expectations that many more banks would go out of business, to the point that the savings and loan index at one point, I think Mike was down, what, 40%? So am
Yeah.
I
Hmm.
slightly off on that, Mike? And those have recovered, but still nowhere near where those prices were. As recently as a month and a half ago, we had the expectations that interest rates were going to rise through the roof and forever, with the 10-year hitting 5%, mortgage rates hitting 8%, doom and gloom, and that's completely reversed. So yeah, we've talked about headline risk an awful lot on this show. My God, if you were following the headlines, you would have got it all wrong. You pretty
And
much
I
would have got it
think
all
I think the one thing we have to remember about the banking crisis is that crisis was not created by some systemic problem in the economy or in the banking sector in particular. These were unique financial institutions who, quite frankly, just got caught flat-footed when short-term treasuries went through the roof and were paying 5%, and now all of a sudden now bank depositors had an option, had an alternative to money market rates. And these particular institutions, suffered the most, and that's what caused the government to bail them out. It wasn't anything wrong with the economy or the banking sector as a whole.
No, they were being squeezed on both ends, Mike. To your point, depositors that were going, "Hey, I can find a better place to park my money and earn a higher interest rate," and the value of the securities they had on their own balance sheet was being discounted.
Hmm.
So they were really squeezed. And look, again, in hindsight, some of these people could have done a better job. The risk officers could have done a better job. I'm not here to point fingers or be smarter than anybody else, but you are correct. To a large extent, they got caught between the proverbial rock and a hard place. And In hindsight, maybe even shutting them down wasn't appropriate in hindsight, but we
Right.
didn't know that then, Mike, right? We didn't know that.
No,
The
then
headlines
look,
were very, very frightening.
yeah, look, I remember like it was yesterday. The banks acted very quickly. It was a Sunday night, and I think you said it frequently. They closed down. What was it, the third and fourth, or the fourth and fifth largest bank failures in the history of the country at that point?
Yeah, and again, somebody can correct me if I'm wrong, but I thought it was second, third, and eventually fifth largest bank closures in the history of this country.
Yeah.
So again, they were that's a significant headline, and I understand people were frightened by those headlines. A lot of people got completely out of the market. A lot of people asked to go to cash or put their investment portfolios in U.S. government guaranteed treasuries. They were very concerned about being able to get their money back. But headlines were very frightening. And again, we didn't know it then, Mike. It's easy for us to look back and go, oh, kind of all worked out. But at the time, and as recently again as a month and a half ago, the headlines were pretty frightening, Mike.
Yeah.
Pretty.
And while that was going on in the beginning of the year, that's kind of the same time that these AI stocks, or the Magnificent Seven, were having their run up, virtually leaving the other 493 companies in the Standard and Poor 500 behind. But those seven stocks were pretty mighty, and they to me, yes, 20% is 20%, and if you own the index, you're up 20%. There's no denying that. But Dom, that those seven stocks, it was almost like a Hollywood movie set where you had the facade, but there was nothing underneath it or behind it.
Yeah, Mike. So I did make some notes, so I apologize if I'm looking down as I'm saying this. But you look at, and we're not here to pick stocks or make commentary on individual stocks, Mike. But you look at a company like one of the Magnificent Seven, like Microsoft, right? Up huge this year because AI technology is going to be eventually be amazingly profitable to this company. But on December 31st of 2022, that stock was trading about $336.
Mm-hmm.
After this insane run up this year, the stock is trading at 374.
Mm-hmm.
A couple more. Apple, everybody's favorite, trading at 177 on December 31st of 2022. Today, after what, a 50 plus percent gain this year, Mike, trading at 194.
Mm-hmm.
Barely a 10% gain. And
Mm-hmm.
our favorite of all time, Netflix,
Mm-hmm.
602 $602 on December 31st of 2022. Today, 491.
Mm-hmm.
So we've had an amazing run up in some of these, and some of them have done a lot better. And I'm going to bring up a few that have done a lot worse, Mike. But when you think about this, and maybe this is a aha moment for a lot of our viewers and listeners, the S&P 500 on December 31st, 2021, 2 years ago, I won't say to the day, but pretty close, was 4,766. On December 22nd, 2023, almost exactly 2 years later, it's 4,763.
Yep. That sounds like a round trip to me.
The definition of the horseshoe, right, Mike? The definition of you went for my favorite line, right, Mike? You go up and down on the roller coaster ride. You end up exactly where you started, but you probably got a little bit nauseous in the process.
Yeah, nauseous and dizzy. And look, let's spend a few seconds talking about 2022. 2022 was a rough year for both stock and bond investors. And I think, Dominic, in talking to our clients about the stock market, they kind of get used to those types of round trips and they understand being fully invested. But what was really horrifying and worse than the roller coaster was the bond market really being a terrible place to be invested in 2022. And really in the first part of 2023, it still was no bargain. I think investors were skeptical and really unsure which way the Fed would turn. And then the flip side of that, Dominic, is 2023 offered these phenomenal short-term, basically guaranteed returns on money markets and treasuries. So it's really been almost a bipolar place to invest money for about 18 months now.
Yeah, again, Mike, you're really lining up your commentary. Bipolar. Think about the average investor out there, and maybe full circle to where kind of I started with my commentary. People are looking at the returns this year and simply don't believe them.
Mm-hmm.
They're going, but, yeah, but I'm hearing that a lot, Mike. I'm not if you are. Oh, we're up this year. We're up nicely this year. Yeah, but because it's been 2 years of a roller coaster ride. And the great news is we kind of are where we were. We've recouped a significant portion, depending on how your portfolio is allocated, you've recouped pretty much a significant portion of your portfolio value. But 2 years to get back to break even, Mike. And we can look at individual stocks, we can look at the major indices, but at the end of the day, it's been 2 years of hard work just to get back to break even.
Yeah, and a lot of that hard work's been done in the last 6 weeks, Dominic. So let's talk about that for a minute. And this is a comment that we've both made to all of our clients over the past six to maybe even longer than that, maybe for the last 3 months. The Federal Reserve has been well, let me rephrase that. The market has been hyper focused on what the Federal Reserve would do as it related to interest rates. And again, this is a comment we've made frequently. As soon as the market kind of got the all clear sign from the Fed that they were done raising interest rates, then we felt the market would have a sustained rally. And what happened, and I know you recall, we thought we got that signal September-ish, August-ish, where the Fed hinted they might be done, and then they weren't, right? There was some economic data that was very, very robust that kind of spooked the market that inflation might be creeping back in. And what happened? We kind of hit lows in October in all of
Yeah.
our portfolios. And then at the end of October, I think you pointed out early November, the Fed, and again, people interpret Fed speak and what they're actually trying to say, but the interpretation was that Jerome Powell and his team really were done short of any news that would really be contradictory to all the data they've been collecting, that they were done raising interest rates. And in the last 6 or 7 weeks, that's when the party really has started.
Yeah, Mike, and not that you and I have a crystal ball that actually works, but we were following the economic data. We were following the inflation data. We're going to pick that up on the second half of this discussion about where the consumer is. But we're looking at the picture and going, I don't know what the Fed is thinking, but they're done. They're done. They're done raising interest rates because at some point you want to slow the car down and you want to not have inflation run away, but you do have the danger here of creating a wreck, and i.e. pushing the economy over the cliff. So in I think a terrific move. Powell was very frank in his speech, in his commentary afterwards, and basically said, "Hey, we're done." And the first time ever, at least for the last 18 months, where the prospects of interest rate cuts came into the conversation, where we realistically can look at the Federal Reserve cutting interest rates next year.
Mm-hmm.
And the market took off of that because the danger of them pushing the economy into and we're really worried about a deep recession. But the danger, I won't say is off the table, but dramatically, the odds are dramatically lower
Of a recession.
of a
Yeah,
recession. And
I
most
agree.
of us are concerned about a deep recession, right?
I agree. Well, let's do this. I'm glad you mentioned interest rate cuts in 2024. I want to, when we come back from the break, I want to talk about that. I want to talk about, how realistic the timing of that might be for investors and all other things that we want to look into for 2024. I know you said we don't have a crystal ball. You might recall I actually do have a crystal ball. Milton Konigsberg, the founder of my company, bought it for me. Full disclosure, it does not work, but I do have one.
Yeah, in full disclosure, I always say ours does not work. But we do have opinions, Mike, and we don't seem to be shy in expressing those. So, yeah, let's pick it up on the other side of this break.
All right, so let's take a quick break and we'll be right back to talk about all things 2024.
Great, thank you.
All right, I'm Michael Hartzman, back with my partner Dominick Tavella. Tonight is Tuesday, December 26th. Full disclosure, we're recording this podcast 1 p.m. Friday, December 22nd. And Dom, we just had a nice discussion on what's happened up until now. And now let's take our proverbial crystal balls and talk about 2024. Um, I know it's a cliche, and I kind of really do hate this question, but I know what keeps me up at night about 2024. What keeps you up at night about 2024?
So, and I'm sure we're going to get into a little bit of, where the economy is going to be and what sectors of the market do we think will perform better than others. But what keeps me up right now at night, Mike, is the geopolitical environment that we're in. Not that we joke about it, not that we have a crystal ball that actually works, but we have good insight into what the next month, 3 months, maybe 6 months are going to look like from an economic perspective. We could get surprises, but I think we have a good feel for where the economy is going to be over the next 3 to 6 months. But as we've seen, geopolitical events around the world can just pop up certainly when no one expected it. And the economic impact could be dramatic. So that today, right now, that's probably number one. And then the political scenario and the election, the end of next year, is worrisome. But I would say one on the list is geopolitics, and two on the list is the political environment here in this country.
Those are both pretty important, and I agree. The one that keeps me up at night, Dom, and I have to give you and I some credit. We said all of 2023, especially in the first half, that the media, the financial media, and investors expecting the Feds to lower interest rates at any point in 2023 was just an unreasonable and unlikely expectation. And to our credit, we were correct. And I will say again right now that the media, again, expecting the Fed to lower interest rates in the first quarter of 2024 is number one, unwarranted. Number two, in my opinion, not likely. And number three, the one thing that could pop the balloon of the market going higher for the first part of the year. I think there are unreasonable expectations and unreasonable pressure that the Fed will lower interest rates in the first quarter of the year.
And if I can add to that, Mike, 'cause, again, shocking, I think you're spot on. The Fed has kind of hinted that possibly 3 rate cuts next year, and we would assume, a 1/4%, 1/4%, very methodically, slowly lowering the interest rate environment we're in right now. Some in the markets are talking 6 to 8 interest rate cuts. 6 to 8, Mike. And again, to your credit, be careful what you wish for, because the mandate is still to get inflation under control. and we've had a dramatic drop in inflation, right? A year and a half ago, inflation peaked at 9%. Right now, it's at depending which measure you're looking at, it's between 3 and 4%. The Fed's goal is to get it in that 2% range. They don't have any incentive to dramatically cut rates until they hit their target. And the only way they're going to dramatically drop rates, Mike, is if the economy falls off a cliff and
Right.
unemployment were to go up dramatically.
And what catalyst is there for that to happen right now? There's no catalyst for that to happen at the moment. And 90 days is the blink of an eye. So yeah, there's no expectation for that. And like you just said, 6 to 8 rate cuts. And this is deja vu all over again. I love to quote Yogi Berra. This is the same conversation we had a year ago about 6 to 8 rate cuts. The market would, as to your point, would fall off a cliff. Why would anyone project that or expect that when there's, in my opinion, and I'm not an economist, there's no evidence of that?
Not yet.
Not
And
yet.
look, there are, and we've used this line in the past, there are cracks.
Mm-hmm.
And we are focused on that. I'm not doom and gloom. It's the holiday season, and we've had a good year, and I'm not looking to burst anybody's bubble. But I think the consumer, especially the lower end consumer, is stressed, Mike. I think we've seen some of the retail sale numbers. We're following things like restaurant spending. We're looking at the amount of credit card debt. I think especially the lower end consumer is stressed. The higher end consumer is actually slow, even though they have the money, Mike. We're seeing sales. They're actually holding back on their sales. So they're still spending. The higher end consumer is still spending, but not quite as much as they were spending before. So we all know the consumer is 70% of the economy. That in itself is going to continue this train slowing down. But to the point that the Fed feels like they need to dramatically lower interest rates, we would have to see unemployment go up dramatically.
Right. And look, to your point, we're supposed to see, and it's unfortunate when it happens, we're supposed to see those cracks in the economy because it's counterintuitive, because that's the evidence that the Fed looks for to take their foot off the accelerator and start to tap the brakes, right? They want to see those cracks. So let me ask you this loaded question. You didn't know I was going to ask you this before the show. We didn't even speak before the show.
Nope, we try
Um,
not to. We really want to be live but honest, with no holds barred.
so I know you're up to your eyeballs in the whole soft landing, hard landing, no landing. So, pun intended, where do you land on that whole scenario as it relates to a recession?
Yeah, I'm going to come back to the employment numbers, Mike. And we've talked about this a lot in the past, but the employment numbers have remained relatively strong, right? So it's possible, maybe even likely they tick up, but we don't have the kind of event that would force employers to go, hey, I don't know what's going to happen with our business model. So I'm going to cut workers. I think most employers will hold on to their workers to the last minute. It's so hard to let somebody go. It's so hard to find somebody to replace them. So I do see unemployment numbers ticking up, but I think overall the employment numbers stay strong, and therefore I'm much more in the soft landing. And by the way, I hate that, Mike. Can I just say that out loud? I've said from day one, this is going to be a plane landing on an aircraft carrier in the middle of a storm. They land safely, they get out of the plane, they go inside and get a nice hot cup of coffee, but it's not going to be smooth. And so I don't think our landing is smooth, but I do think we avoid any kind of major recession, large unemployment numbers, real heavy decline in economic growth.
I agree with you. And we'll just use the back of the napkin definition of a recession, which is two negative quarters of gross domestic product, GDP, in a row. I think this quarter, the last quarter of this year, it's not going to be like last quarter, the third quarter, where somehow the GDP was up 5%. But I think it's unlikely, Dominic, that it goes from 5% to a negative number this quarter. So let's assume we end this year with positive growth. So I agree with you. Maybe the second and third quarters or the first and second quarters, maybe we see the economy softening even more. But I'm not even 100% sure, Dom, that might actually happen. I think that the economy has been resilient. We may get one negative quarter, but I could easily see us not having two in a row.
Yeah, again, Mikey, I think let's focus on that last comment, two in a row. So
Right.
I know we've learned that the two negative quarters in a row is not in itself the definition of a recession, but I think it's likely we are flat to slightly negative in the first quarter of next year.
Mm-hmm.
Historically, the first quarter of the year is the worst for economic growth. And it makes sense because people spend a lot of money for the holidays, then they're broke. So they don't spend as much money. They're trying to pay down their credit card debt. Winter, there's not as much economic activity. So generally, the first quarter is the worst quarter. So
Mm-hmm.
would I be surprised if we have negative growth the first quarter of next year? No. It would be surprising to have two quarters in a row of negative growth. And by the way, back to one of your earlier questions, that's when you kind of sense the Fed might do its first cut, but a mild one, 0.25%. Hey, the first quarter ends up being around flat-ish, maybe negative a little bit, and the Fed might go, hey, let's cut a quarter just so we can kind of make sure we don't go into a negative second quarter, right? But a hard landing, recession, I think, and frankly, I think it's a geopolitical event where the consumer really gets frightened and stops spending completely, and that's not likely to happen.
Yeah, and I know you mentioned that earlier, and I do agree with you. Some of the world events are certainly unsettling, and up until now, Dom, the market and the economy and financial media has not ignored, but they've been so hyper focused on interest rates that they really haven't been paying attention on those geopolitical events. It's a little early to focus on the election, but there are certainly things out there in 2024 which can cause, some chaos and some bumps in the road. But again, that's normal, right? If there wasn't any bumps in the road in the market, well, that's what would make us nervous, that things are too quiet.
Yeah, look, you said what keeps me up at night. It's the things we don't know, right, Mike? We know where consumer debt is, and we know that the especially the lower income consumer is really stressed right now. We know where corporate profits are. We know corporate growth. I mean, we can look at this data. We get economic data every week. So it's kind of, think of the weather report. It may not be entirely accurate, but you have a good idea of what the picture is going to look like a week and a month from now. But these things that come out of nowhere, and I call it the meteor that comes out of the sky and hits you in the head. It's very hard to plan for those, Mike. It's very hard to anticipate those. So when they do happen, the markets react typically violently. And then once they understand what the economic implications are, they rebound. But we are dealing with some potential scary stuff out there.
Mhm. Heading into the new year, Dom. Well, again, one more thing from my perspective about 2023 heading into 2024. We were, as our models go, extremely conservative, I would say, for the first 9 months of the year. Full disclosure, we were a little skeptical about that first half run up in the market because it was driven by basically 7 companies. So we had a lot of cash going to the last quarter of the year, probably more cash than we've had, at any time in running these models. And here we are now, towards the end of the year. We've really reduced that cash position. We've really are participating in this rally very robustly. And I think heading into 2024, we'll continue to do that. But what sectors are we focusing on heading into the new year?
Yeah, Mike, if I could just spend a minute on what you just said. So yeah, if we look at it as of the end of July, and you look at where the S&P was for the year and the Nasdaq for the, but literally 90% of that performance were the 7, 10 stocks, right? And we've talked about it. We can go back to the old podcast, but if you looked at the rest of the market, most of it was either flat or negative for the year. What is really exciting to me is that, for all the reasons we described, the Federal Reserve and their interest rate policy has dramatically changed, but the rest of the 490 stocks in the S&P, mid-cap stocks, small-cap stocks have started to participate. And so our portfolios have done a lot better in the last quarter, because we put a lot of that cash to work. We did it opportunistically. We'll put that aside. But the parts of the market that were not behaving well, and you can argue weren't behaving at all, Mike, all of a sudden started. So in the last month, these NASDAQ stocks are up about 5%, which is great. But value stocks are up 14% over that time, Mike. Small cap stocks are up 13% over that time. And that's what we're talking about. The market is broadening out, that it's not just 7, 10, 12 stocks that are carrying the weight for the market, that the broader markets now are participating and believing in this economic recovery story. And so our portfolio is the combination of, we put a lot of money to work when things didn't look all that great, and the portion of the portfolio that, agreed, Mike, was very conservative, is starting to participate. So that looks better. The question now is, what is this picture going to look like in 2024? And that brings us back to our crystal ball. So maybe I'll flip it to you first, Mike, and give me your opinions, and then I'm happy to kind of comment on that.
So as I look at the best performers of 2023, it's basically, the chart has been turned upside down, because the best performers in 2022 were energy, utilities, and consumer staples and healthcare. And guess what? They're the worst performers this year. And the worst performers in 2022 were technology, communication services, and consumer discretion. And
Worst performers.
Right.
Underline, Mike. Worst performers in 2022. You want to rattle them off one more time, Mike, please?
Yes. Technology, communication services, and consumer discretionary. Technology was up 57%. Communication services 50%. And consumer discretionary 42%. Now,
And worst performers this year, Mike?
consumer
Remember last year's
staples.
best performers, worst performers this year?
Yep. Consumer staples negative 1.4. Energy negative 1.6. Utilities down 7. Now,
And again, I did make some notes, so I apologize for looking down, Mike. But think of a company like Bristol Myers, somebody bobblehead on TV's favorite company. Great performer in 2022, 2023 minus 27%.
yeah.
Moderna, amazing performer in 2022. Year to date, down 46%. There's your healthcare sector. Energy, Chevron, minus 12% year to date, in an environment where the S&P is up over 20, Mike. And I can go on and on with the Verizons or the Disneys of the world. But it's amazing that last year's winners are this year's losers. This year's losers are last year's winners.
Right. So the deck will be shuffled again starting a week from Tuesday. And I still think the story, Dom, heading into 2024 will be about interest rates. So no, I don't think the tech sector will be up 57% again, but I think there is a clear correlation. When interest rates go up, Small cap technology stocks do worse. When interest rates go down, small cap technology stocks do better. So I feel if the interest rates will continue to decline this heading into 24, I think that would bode well for the small caps and for the technology and consumer and the communications sector. If we do go into a recession, or even if the economy continues to slow, I would be stunned that consumer discretionary, just the word is in there, discretionary income. I don't see how that sector is up 42% again if we continue to see a slowdown in the economy.
Again, couldn't agree with you more, Mike. So I'm just going to come back to this number. In the last month, that tech growth sector is up about 5%, which is very nice. But the two other areas that we talked about, small caps, mid caps, and we talked about the value sectors up double digit. And this is the rotation, and I think it's very conscious, where people have done very well in certain areas, and it's time to take some profits and buy things that maybe haven't done as well, or from a valuation perspective, which is the way we look at it, they're selling at a bargain, right? Sorry, I know you love when I use the word wonky, but if you look at the S&P right now, it's trading at a 20 multiple. But when you look at these value stocks and even small cap stocks, they're in a 10 to 12% time multiple. So they're selling at a very deep discount to where they should be valued. So I think I agree with you, Mike. There's a lot of opportunity in small caps. I think there's a lot of opportunity in mid cap stocks, and to the extent they've actually started to perform pretty well, they've performed way less well than these large cap growth stocks. So I think value stocks, dividend paying stocks, should have a good year next year.
And before we go, let's spend a few minutes now talking about the bond market. Again, I'm going to use your word. I don't think I've ever used this word in 2 years of this podcast, but to get a little wonky, the yield curve, the Treasury yield curve, has been inverted for 2 years. And what that means in plain English is short-term rates are higher than long-term rates. The yield curve is basically upside down. It's been a gift that keeps on giving. 5% guaranteed, to lock your money up for a year. It's phenomenal. I'm pretty sure, Dom, that sometime in 2024, that Treasury market gets right side. And that party's also going to end. And again, when all these treasuries come due, Dominic, people are going to be looking for a place to put that money. And if the stock market hasn't fallen out of bed and the bond market now is back to normal, you could also see another migration of money going back into the stock market, because the easy guaranteed money in the treasury market is in my opinion, basically going to come to an end.
Yeah, spot on, Mike. And it's one of the things that gets talked a lot about in our world when you and I go to these meetings and meet with these institutional money managers, that we're sitting with an excess of $6 trillion, with a T, trillion dollars sitting in money market accounts. And why not, Mike? As you said, you're earning what, 4 or 5% with I hate the word no risk, but I'll say virtually no risk. You can buy T-bills, same kind of rates. But if the Fed is telling you that they will be cutting rates next year, by definition, that means those short-term rates have to come down. And so as those rates get lower and lower and lower, it's conceivable to me and us and everybody in the industry that those dollars are going to be looking for something to put and park that money to. And certainly the fear of missing out, FOMO, indicates that they might be looking at the stock market as an alternative to park some of that money.
Yeah, and the other part of that is, when does the financial sector, in particular insurance companies, banks, that sector has also been struggling for a while, and you would think that if money starts to go back into motion, the real estate market improves, people start buying and selling homes again, that should also bode well for the financial sector, don't you think?
It should, right, Mike?
Right.
Because the same seesaw that got, especially the savings and loan sector, that just decimated it in March, the same rationale says that the valuation of their portfolios now is rising, right? Lower interest rate environment, the values of these bonds goes higher, so their balance sheet should be getting looking better. You would argue that the financial sector should perform very well next year. Again, one of those sectors that way underperformed this year should look better next year. That one's a little bit more difficult to gauge because the consumer debt is, I think, a real issue, Mike. I don't think we have enough time to go through it today, but I've had many a client call me up and tell me that their credit card statement shows that they're paying interest rates in the 28, 29, 30% range. That's what's really putting a lot of stress on consumers. So if these banks are dealing with a lot of defaults and a lot of people that can't pay back their credit card debt, that could be an issue going forward. So I do like the sector, but I think the jury's still out on whether it'll be one of the better performing sectors next year.
And that is a topic for another show, how these banks get away with charging 25 to 30% interest is just beyond my imagination.
Mikey, you look at a government that claims that they're in line with consumer interests, and I understand banks need to make money, and they should, and we want them to have a healthy balance sheet because they're the backbone of growth in this country. But when I'm trying to think of a polite word. I'm not sure I can, Mike. Taking advantage of individuals, especially lower income individuals, and you're charging them 30%. And that sounds outrageous, Mike. I bet you there are people that listening to us that don't believe it. I had a client send over their balance sheet and their credit card debt. Most of it was sitting at 28 to 30%. And how is especially a lower income individual supposed to pay that debt back, Mike? Come on. Where does our government step in and say, you know what, that's excessive? Come on. That's a little ridiculous. And I'm sorry, I'd love to get a banker up here and argue with me on that one, Mike. Sorry if I'm venting.
No, it's
My
a good look, it's a good vent. We've talked about it before, and it's just insane to me. And look, as we're about to close out the show, I think the lessons of 2022 and 2023 as we go into 2024 and beyond, Dominic, is it's our job to keep our clients diversified, right? Because as I said, in a week and a day, the deck is going to get reshuffled and we're going to start all over again. And we have no idea which ones are going to be the winners or which ones are going to be the losers. But our job, to the best of our ability, is to keep our clients diversified and not make those large bets.
And try to the best of our ability, Mike, to keep that roller coaster. We know anybody that tells you it's not going to happen is just simply a fool or a liar. We know we're going to go through a roller coaster, and we certainly know that roller coaster is going to continue in 2024. There's no reason why it's going to be any different. But we want to keep that roller coaster highs, maybe not as high, sorry, but the lows nowhere near as low. And therefore, you can arrive at your destination, your financial goal, in as healthy a position as possible.
So listen, on that note, I think it's a good place to wrap the show up, wrap up the year. But I would be remiss if I didn't wish you a happy birthday. Today is your birthday, so enjoy the day with your family.
You just let the cat out of the bag for every listener and viewer that we have. So I will find a way to get even with you on that one. But thank you for your kind words, and your birthday, not too many days ago. Hint, hint, hint.
Yeah.
Yeah, Mike. We look, and I know we're running out of time, but at the end of the day, we do want to count our blessings. I am eternally grateful for our family, our children, our grandchildren, our partnership. the faith that our clients put in us. I know it can be difficult for them sometimes to kind of put that faith in us and in the world that we live in, but I am eternally grateful for all of it. And God bless all of you. Be healthy, be safe, and a very, very happy new year.
I cannot say it any better, my friend. Everyone out there, have a happy and healthy Christmas, Hanukkah if you celebrate it, and a happy New Year.
Happy
And we'll
holidays to all.
and we'll see you all in 2024. Have a good night, everybody.